Stock markets are closed today for former President Carter's funeral, but investors looking ahead to tomorrow's jobs report. Joining us now, Catherine Rooney Vera, chief market strategist, chief economist at StoneX. Are you worried about inflation like the Fed, Catherine?
I think we should be worried about inflation if we see continued above potential growth here in the United States, and if the Department of Government Efficiencies is not successful in bringing down expenditures. Then I am more concerned about inflation. I think the market should be as well.
If the Fed is worried about what was that? They did 50, they did 25, they did it again. They're doing 2 more, and at the same time they're saying, but not to worry, because we're thinking about it. It just seems to me like they're trying to have it both ways. If I was worried about it, I wouldn't cut, and I wouldn't have cut.
I think they're on hold for now, Joe, and they're probably going to be on hold for the foreseeable future, because the last thing a central bank wants to do is reverse policy and potentially hike. So I think that is a risk that no one is talking about quite yet, and I think it could be something that occurs if inflation does get worse. I'm talking about, above 3.5% core piece.
That's way too high, obviously, and all you got to do is is compound it for a couple of years and look at the effect it has on people that can least afford it. I don't know. Do you think that the economy is also, the labor market, slowing at this point? It seems like we've got pretty balanced risk. Neither side. Look, do you see the economy accelerating or inflation declining? That's what we'd really like.
Well, the good news is 2 things. One, private investment is very strong. The IMF put a data point at 28%. It's near record amounts of private investment globally, so that's a very good thing. And economic growth here in the United States is still above potential, which we estimate at 1.8%. So if the economy grows above 1.8% this year, as it did last year, that's inherently inflationary. So I think those 2 things and the end of this phenomenon of global savings glut and secular stagnation, to me, means that term premia are going to continue to increase. The risk of inflation ever coming back to 2% for the foreseeable future, I think, is really high. So the Fed has an implicitly higher inflation target at this point. So I think best case, Joe, would probably get 2 rate cuts this year. I think it's not going to happen in the first half of the year. And I think the underpriced risk, and what I'm telling our clients, is to protect yourself against the risk. The Fed doesn't cut at all. If, in fact, we do get this turbocharging of the U.S. economy, which is what a pro-cyclical, supply-side oriented Trump policy would do. Now, we're facing fiscal pressures, and I think the bond market is indicating that is going to be the central focus. I think for this year, finally, the markets care. And I think they care because we're coming into the next administration with an above-trend economic growth, with high investment. But the good news here is that we have strong productivity. So I think that would productivity levels, if they sustain themselves where they're at, and investment sustains itself where it's at in AI and data, I think we could keep inflation above 2%, but certainly not unanchored.
Let's say all these great things happen and we get 2 cuts, and we do have some supply side growth, whatever. Is that enough to keep multiples where they are? 2 cuts, I don't know. We're 22, would you say? And will the economy deliver double-digit earnings growth for most corporations to give us an advance in the indices? Because they seem like, they're at levels right now that assume a lot of really positive things. Can it move higher? Can it go up 15% this year, Catherine, the S&P?
Yeah, I think that's going to be a tough run, especially because, as you said, a lot is already priced in. But the fact is that corporate profits are at or near record highs. And I think that if U.S. economic growth continues at the pace that we're expecting, we could see additional upside, but we shouldn't expect this year does as well as last year. So I'm saying, yes, maintain your positions in S&P 500, overweight them, play the Trump trade. I think there's still juice in banks for sure. I even like small banks. I think there is more upside. But I'm, again, recommending that clients protect their positions for the risk of inflation and buying protective puts on the S&P 500, especially in the technology sector, which could face some headwinds if I'm right and the Fed potentially doesn't further cut for the foreseeable future.
I just wonder what those puts cost. They're probably not cheap, I would think, at this point. Could we ever see an early payoff of AI? That would be nice if we just had like a quantum addition, a quantum addition of something that wow, well, we didn't take that in, like the internet. I mean, the internet changed everything.
Yeah, I get what you're saying, and I agree with you. I think AI has to deliver now. We've reached a mature phase, so we shouldn't expect, a corporate guidance or earnings calls. Anyone who uses the buzzword AI to get a boost in their stock price anymore, because we've reached that mature phase. So I do think that AI has to deliver, and I don't believe that what we've seen in productivity increase, which has been pretty phenomenal for an economy as mature as ours and as developed as ours, will continue without AI actually delivering. So I think we have not yet seen the full effect or even the full implementation of automation and AI. So no, we have not seen it yet. And I think it's something that will transpire over the course of the medium term. I'm talking years here. So I think more is in the pipeline, and that's all good. That brings additional efficiencies and will curb the higher, structurally higher inflation rate.
All right, Catherine, thank you. What's StoneX? StoneX. I'm trying to think about that. It used to be Bull Tick.
A different name.
Okay.
We have an upgrade now.
Okay.
Yes, StoneX.
Stone.